Welcome to a new podcast episode. When foreign investors think about Germany, they often associate it with stability, legal certainty, and complexity. What many do not realize, however, is that Germany doesn't just regulate investments. Germany often invests alongside you. Today, we take a closer look at public funding and co-financing in Germany and why this can be a real game changer for international investors and startups. Let's start with what do foreign investors usually misunderstand about public funding in Germany?
The biggest misconception is this: many believe public funding is only available to German founders or German owned companies. That's simply not true. What matters is where the company is located, not the nationality of the shareholders. If a startup or business is based in Germany, foreign investors can benefit from public funding just as much as domestic ones. For many investors from the US, UK, or Asia, that's a real eye opener.
Why should investors care about public funding at all?
Because public funding directly reduces risk. In Germany, funding often comes in the form of non dilutive grants, low interest loans, or guarantees. That means less capital at risk, no or limited loss of equity, and better liquidity for the company. In other words, private capital is leveraged by public money.
Many investors are skeptical when they hear the word subsidies. Why shouldn't they be?
Because funding in Germany is not handed out casually. Applications involve business plan reviews, technology assessments, and market plausibility checks. When a company receives funding, it's a form of external validation. For investors, this means someone else has already challenged the idea, the model, and the feasibility. Germany effectively becomes a silent co-investor.
Where does this funding actually come from?
There are three main levels. First, European Union level programs, particularly for innovation, deep tech, AI, and sustainability. Second, federal programs, including development banks, innovation grants, and energy-related funding. Third, regional and state-level funding, often tied to specific locations or industries. The key point: these instruments are often combinable, if the structure is right.
If this is so attractive, why do so many investors overlook it?
Because the funding landscape is complex and fragmented. There's a language barrier, regulatory specifics, and timing is critical. Funding must be considered early when structuring the company or investment. If you try to add it later, it's often too late. That's why many investors leave value on the table without even realizing it.
So, what should international investors keep in mind?
The key takeaway is this: Germany doesn't just offer stability, it shares the risk. If you structure your investment correctly from the start, you can combine private capital, public funding, and long-term legal certainty. That creates a very resilient investment setup, especially for technology-driven and innovation-focused companies. That's why Germany is not a place for short-term speculation, but for sustainable, well-structured growth.
Thank you, and thanks for listening. If you'd like to explore how public funding and smart structuring can support your investment in Germany, the Haberlander GmbH is happy to advise. More information can be found at www.haberlander-gmbh.de.